$3.7 billion. That's the amount Blackstone just had to release from a single private credit fund in one quarter, after investors demanded their money back faster than the firm wanted to give it. The fund is called BCRED, Blackstone's flagship $82 billion private credit vehicle. According to Reuters reporting from March 2026, redemption requests came in at 7.9% of the fund in one quarter. That's well above the 5% cap Blackstone is allowed to enforce. They had to lift the cap to 7%. And the firm and its employees personally injected $400 million of their own money to make sure those redemptions got paid out. Today, we're breaking down exactly why Blackstone locking up billions is the same 2008 warning sign for U.S. housing. And most homeowners have no idea this story is even unfolding. Because here's what no one in the financial press is connecting for you. There's a specific date in June 2007, exactly 14 months before Lehman Brothers collapsed, when another major Wall Street firm did almost the same thing Blackstone is doing right now. We'll give you that date in a minute. There's a verbatim quote from a major French bank in August 2007 that historians now mark as the official start of the Great Financial Crisis. And what's happening across private credit in 2026 reads like the prequel. And there's a brand new lending platform Blackstone launched earlier this year that puts them directly between Wall Street's panic and the houses being built in your zip code right now. Stick with us, because by the end of this, you're going to understand exactly what these redemption gates mean for your home's value, your mortgage rate, and the supply of new housing hitting the market in 2027. Here's the thing about that BCRED redemption number. It didn't happen in a vacuum. In the same quarter, gross sales into the fund were $1.9 billion. Solid, but decelerating. Net flows for the quarter? Negative $1.4 billion. That's the first negative quarter the fund has seen at this scale. The portfolio is now marked at 96.4 cents on the dollar on average, but the bottom 5% of those loans are trading under 70 cents. That's the bracket where private credit goes from manageable to this is going to leave a mark. And BCRED isn't alone. Blue Owl Capital halted regular quarterly redemptions on its $1.6 billion OBDC-2 fund in February. Co-president Craig Packer said, and I'm quoting directly, "We're not halting redemptions. We're simply changing the method by which we're providing redemptions." That's corporate translation for, you can't have your money the normal way anymore. Across the entire business development company sector, average redemption rates jumped from 1.6% of net asset value in the third quarter of 2025 to 4.5% in the fourth quarter. Among the largest funds, those with over $1 billion in assets, redemptions spiked 217% quarter over quarter. Here's where this connects to a moment most people have completely forgotten. On June 7, 2007, Bear Stearns froze redemptions on two of its hedge funds, the high-grade Structured Credit Strategies Fund and the enhanced leverage version of it. Investors who'd been told they were in AAA-rated high-grade product were suddenly told they couldn't have their money back. 15 days later, on June 22, 2007, Bear Stearns pledged $3.2 billion of its own money in a collateralized loan to rescue the high-grade fund. By July 17th of that year, the high-grade fund had lost 91% of its value. The enhanced leverage fund was wiped out completely. Both filed for bankruptcy by July 31, 2007. And then came August 9, 2007, the date financial historians now point to as the actual start of the global financial crisis. That morning, BNP Paribas suspended 3 of its funds and issued a one-sentence statement we want to read to you word for word, because the language matters. The complete evaporation of liquidity in certain market segments of the U.S. securitization market has made it impossible to value certain assets fairly regardless of their quality or credit rating. That's the quote. Complete evaporation of liquidity. Within hours of that announcement, the European Central Bank pumped 95 billion euros of emergency cash into overnight markets. Days before the freeze, BNP's CEO had told the press his bank's subprime exposure was, quote, absolutely negligible. From that moment to the collapse of Lehman Brothers was exactly 13 months. From that moment to the collapse of Bear Stearns itself, just 7 months. If this is the kind of analysis you came here for, primary sources, exact dates, the connections no one else is making, make sure you subscribe and hit the notification bell. This channel doesn't take a single dollar from Blackstone, doesn't take a dollar from any home builder, and doesn't take sponsorships from anyone. Here's what makes the 2026 version of this story different. According to Moody's private credit outlook for 2026, the private credit industry will exceed $2 trillion in assets under management this year and approach $4 trillion by 2030. 5 firms, Apollo, Ares, Blackstone, Carlyle, and KKR, now manage a combined $1.5 trillion in what's called perpetual capital. That's roughly 40% of their combined assets, up from 35% in 2021. And here's the part that gets very little airtime. According to a Bank for International Settlements bulletin published in 2025, the retail share of private credit has climbed from virtually 0 to 13%, about $280 billion over the past decade. That's regular investors, often through wealth management platforms, holding pieces of these illiquid loans. The growth happened because regional banks pulled back from commercial real estate and construction lending after the Silicon Valley collapse in March 2023. Regional banks still hold about 70% of all commercial real estate debt, but they now supply only 20 to 30% of new capital. The gap got filled by private credit. According to MSCI data, investor-driven and private debt lenders originated 34% of all construction loans in 2025. That's the top lender category for the second consecutive year. And earlier this year, Blackstone launched a homebuilder lending platform specifically aimed at financing residential land and development. Now, here's where it gets worse. Lennar, the second largest homebuilder in America, disclosed on its Q1 2026 earnings call that it has cut its home building inventory from just under $20 billion 2 years ago to $10.5 billion. Less than 5% of its land is on its own balance sheet anymore. The rest is owned by what they call land banking partners. And the names include Millrose, Angelo Gordon, Domain, Hearthstone, and Apollo. Yes, that Apollo. The same firm in the private credit top 5. So one of America's largest home builders is now structurally dependent on the same Wall Street machine that just started gating redemptions. And again, wait, it gets worse. The National Association of Home Builders Confidence Index sits at 37 as of May 2026. That's the 25th straight month below the 50 break-even line. 32% of builders cut prices in May, 61% used incentives, and NAHB Chief Economist Robert Dietz had a line I want you to remember. An increase of just $1,000 in the cost of a home would price out 156,000 households. More than half of Americans cannot afford a $300,000 home. Half of Americans. And wait, it gets even worse. The multifamily commercial mortgage-backed securities delinquency rate hit 7.15% in March 2026, a post-2008 high. The special servicing rate climbed to 8.75%. 80% of the new distress is concentrated in just 2 markets, New York, New Jersey, and Houston. And the Mortgage Bankers Association says there is $875 billion in commercial mortgages coming due in 2026 alone, against $5 trillion outstanding. The credit companies and other lenders bucket, closest proxy for private credit on the map, has 29% of its book maturing this year. That's $163 billion that has to be refinanced or rolled over, while the people doing the refinancing are themselves dealing with redemption stress. Here's our controversial take, and we're ready for the comments on this one. Have at it. Let her rip. The next housing downturn is not going to look like 2008. It's not going to be a foreclosure tsunami driven by subprime borrowers. It's going to be a supply-side seizure. Builders can't get cheap construction loans. Multifamily completions in 2025 already dropped 20.3% from the prior year. Units under construction are down 12.2% from the late 2023 peak. Every economist out there is telling you America has a housing shortage. What they're not telling you is that the financing pipeline that builds new housing is being squeezed at the exact moment we need more units. Fewer units delivered means existing homeowners keep their pricing power even in a slow market, but it also means buyers stay locked out, rents stay elevated, And the housing affordability crisis everyone keeps talking about doesn't get better, it gets worse permanently. I know that's not the take you'll hear on most housing channels, so tell us in the comments below, do you think the next housing downturn looks like 2008? Or do you think it looks like a slow, permanent supply seizure? Drop a comment, hit that like button if this is the kind of analysis you want more of, and let's see where the audience comes down on this one. Let me get specific for the three groups of people watching this video. For homeowners, and this is most of you, here's the good news. The data from Cotality, formerly CoreLogic, shows the National Home Price Index was up 0.4% year over year in April 2026. Cotality forecasts annual gains of 5.3% by April 2027. Mortgage Bankers Association data shows American homeowners are sitting on roughly $36 trillion in home equity. So if you own and you're not selling, you're fine. But pay attention to your state. 11 states posted negative year-over-year price changes in April. South Dakota down 3.4%, Hawaii down 2.8%, Washington, D.C. down 2.5%, Florida down 1.6%, and Cotality flagged 5 metro areas with the highest 12-month decline risk: Cape Coral, Fort Myers, Greenville, Anderson, Lakeland, Winter Haven, Marietta, and Tampa. For buyers, here's your reality. The 30-year fixed average 6.52% as of June 11, 2026, according to the Freddie Mac Primary Mortgage Market Survey. The median existing home sale price hit a record $429,300 in May 2026, according to the National Association of Realtors. Run the math. A 20% down payment on the May 2026 median, financed at 6.5%, cost you about $2,171 a month in principal and interest. In 2021, the same buyer with the median home of about $346,900 at 3% paid $1,170 a month. That's a $1,001 monthly difference, an 85% increase. For sellers, pay attention. Redfin reports the typical home now takes 49 days on market, up 3 days year over year. There are 1.48 million homes for sale. That's roughly 4 months of supply. Foreclosure starts are up 20% year over year per Atom Data Solutions. Serious delinquencies, loans 90 days or more past due, are up 21% year over year per Intercontinental Exchange Mortgage Technology's June 2026 Mortgage Monitor, with most of the rise concentrated in FHA loans. If you're selling, your buyer pool is shrinking by the month. Here's the part where we have to be honest with you, because we're not in the business of selling fear. The Federal Reserve's May 2026 Financial Stability Report, called Private Credit Risk, Limited and Manageable. The International Monetary Fund's April 2026 briefing said default rates are running 2 to 3%, and the magnitude is somewhat manageable. The Fed's 2025 stress test of the big banks concluded that even after simulating 5 major hedge fund failures, the banks stayed above their minimum capital requirements. So none of this means a Lehman-style collapse is around the corner tomorrow. But Jamie Dimon, the CEO of JP Morgan Chase, said in October 2025, after the Tricolor and First Brands bankruptcies, and I'm quoting, "When you see one cockroach, there are probably more." That's the line. That's the warning. Because what 2008 actually taught us is that the people who tell you that the risk is contained are using the same playbook the BNP Paribas CEO used when he called his bank's subprime exposure absolutely negligible. This isn't the crash. This isn't the prequel. This is the slow motion seizure of the credit pipeline that funds the houses you're going to buy, the apartments your kids are going to rent, and the developments your local economy depends on. And that's why we keep saying it. 2026 is not the year of the Great American Housing Crash. 2026 is the year of the slow motion squeeze. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next. Until next time, friends.